Wealthy investors don't buy real estate because it generates the highest returns. Most times, they're not even buying for the near-term cash flow. They're playing a completely different game. The ultra-wealthy buy real estate for the tax losses. Real estate is the only place where you can put $1 million to work, yet show a $500,000 loss in your tax return without losing a single dollar of actual capital. That's the game. They're not empire building, they're utilizing tax strategy. So once you see how this math works, it can unlock an extra gear as you're growing your own net worth. I'm Brad Johnson, managing partner at Evergreen Capital. We advise accredited investors on unique and tax-efficient investments. And our clients have deferred tens of millions in taxes using these strategies I'm about to walk you through. Today we're breaking down why wealthy investors keep buying real estate even when yields are low, rates are high, and everyone else is debating cash-on-cash returns. Today we're going to cover the following 6 points. How bonus depreciation works, the math on tax savings, who can use these losses, how to maximize the long-term value of depreciation, how to use it properly so you don't get burned. Okay, and before we start, just realize that our clients don't want to fix toilets, they don't want to manage Airbnbs, and they definitely don't want a side gig. They want professional, passive version of real estate, the version that generates large paper losses, compounds wealth, and materially reduces their taxes. All right, section 1, how bonus depreciation works. Real estate lets you show a taxable loss even when the property is producing real income. Why? How is that? Because the IRS lets you depreciate the building as if it's falling apart. The tax code treats most residential buildings as if it will be worthless in 27 and a half years. Of course, we all know that most real estate appreciates in value, so they give you tax deductions for something that is actually making you money. So in other words, from a tax standpoint, your profits are getting treated as if they were expenses. As if that wasn't enough, the IRS also allows you to break the building into component parts through something called a cost segregation study. This allows you to break up the individual components of the building into separate depreciation buckets. Now, I know that sounds complicated, but stick with me. So for example, the carpet and the fixtures are often 5-year property, while the land improvements are 15-year property. This is where bonus depreciation comes in. Thanks to the new tax bill, the IRS will let you accelerate everything 15 years or less into the first year. So we're taking 15-year property, we're moving into the first year for bonus depreciation. It's kind of like a tax time machine. So those short life components often make up a massive chunk of the building's value. So you get to combine that with the leverage, right? Because usually when you're buying real estate, you're using debt. And now all of a sudden your equity gets to be magnified. If you invest $1 million, the property might generate $500,000 to even $1 million of paper losses that first year, depending on the type of real estate you're buying. That's why wealthy investors love apartments, they love industrial, self-storage, manufactured housing, really anything with a strong cost segregation potential. And to be clear, this is the standard tax code. It's not some crazy loophole. This is what the IRS and the government want to incentivize. They want people to invest in real estate properties, so owners continue to maintain high quality real estate. All right, section 2, the math on tax savings. Let's keep this simple. If you're in a high tax bracket, both your federal and state taxes like California or New York, pretty much anywhere on the coast, a $500,000 paper loss can translate into a $200,000 tax saving that first year. And that's from an asset that, once again, is actually appreciating usually or generating income and delivering real economic value. That's why wealthy investors tend to not obsess over whether or not that property is generating a 5% or 3% cash-on-cash yield that first year. What they really care about is investing in high-quality assets that are run by elite sponsors with great track records that can go ahead and deliver that 6-figure tax savings in that first year reliably without taking a lot of unnecessary risk. That year one cash flow is small, taxable, and fairly irrelevant to high earners. It's not going to move the needle on their net worth, and we can also put them in other investments that typically earn dramatically higher cash flow yields than most real estate. But what they do care about is that depreciation. It has the potential to change the trajectory of their net worth. All right, section 3, who can use these losses? Now, this is the part that most people mess up. If you're not a real estate professional, it's called reps, i.e. your spouse or you are not full-time in the real estate profession, you cannot use bonus depreciation to offset ordinary income, i.e. your W-2 income. These are passive losses. You need to match them up with passive gains. That means you're going to offset other investments that are passive to you. Maybe that's other real estate assets. Maybe that's cash flow from a passive business investment you've made, a private equity investment. And this is why coordinated investment and tax strategy is so important for these investors. The wealthy, with help from their advisors, stay on top of their investments and work to line up the sale of passive assets with the purchase of new ones. Because if they get that right, it enables them to defer taxes into the future indefinitely. You just keep moving forward, deferring and deferring those gains year after year. All right, section 4, the long game, timing, structure, and strategy. Now, once again, this is not a tax hack. Most people treat this like it's a one-time bonus, but that's the wrong approach. You want to think of this as an evergreen, consistent tax strategy for depreciation. If you flip a real estate deal in 3 years, you hand back the benefits through depreciation recapture, and of course the capital gains, the taxes on that profit. So the wealthy playbook is completely different than that. That's short-term thinking. The wealthy want to hold long-term. They want to hold their real estate assets for the very long term because they can keep deferring those taxes again and again into the future to let compounding do its magic. And then what they'll do is they'll refinance for liquidity. So they'll get a new loan, recoup the amount that they invested in the property, which is not taxable because it's debt, and then they can let the returns compound from there with no more risk in the deal. That's the long-term strategy the wealthy use for real estate. Build losses, defer gains, refinance so you have no more capital at risk, and you just use that money to reinvest in new deals, keep the compound going, and do that strategy year in and year out. Because real estate is a decades-long tax strategy. It's not a short-term trade. Section 6, all right, we're getting close to the end here. Why shouldn't you do this by yourself? You can, but the wealthy tend to not invest in real estate as an operator. They tend to do it passively. And this isn't a go buy a duplex on Zillow type of strategy. If you're going to do this correctly, you need the right property types that can maximize the tax advantages of bonus depreciation that we just walked through. You're also going to need stellar management. You want to select a manager that has an excellent track record, a real estate sponsor who knows how to find and run properties. Ideally, they know how to find these things off market. They also need to know how to execute cost segregation studies and prepare the tax forms, the K-1s, correctly so you can take advantage of those losses. So your CPA advisors need to understand passive versus active versus material participation rules. It gets kind of complicated, and if you don't do this right, you lose all the benefits of the math that we just walked through on depreciation. So you need to work with your advisor to make sure your allocations are sized correctly for your strategy and your liquidity. All right, a couple questions. Do I need to become a landlord? No, this is a professional passive investment. This isn't going out and buying a bunch of Airbnbs and becoming a hotel operator. Do I need to be a real estate professional? No. Once again, these are passive losses in institutional quality deals. Do I need to treat this as a second job? No. You don't need to go out there and find these deals yourself. You need to structure these deals the correct way with the right team in place to manage these assets for you. Now, stocks can't do this for you. An index fund certainly isn't going to generate these kind of tax losses. Real estate is really the only major asset class where you're going to be able to make money, show a loss, reduce your taxes, and compound faster with after-tax returns. Okay, to wrap this up, the wealthiest investors do not buy real estate because they're passionate about architecture. They are buying real estate because the tax code rewards them for owning productive assets. And once you understand that, tax strategy starts to click and it begins to work to your advantage. Most advisors, most wealth management firms sell the same basic playbook to everyone. Index funds, bonds, maybe a REIT, right? If you want to get real estate exposure. They're not showing you the best world-class real estate deals and funds from top-tier managers. But that's exactly how the wealthiest investors use real estate. We've purchased and exited over $100 million of real estate for our investors, and I began my career as a real estate investor, 20 years of investing as an operator and purchasing real estate. So I know what I'm looking at and talking about when analyzing real estate operators and sponsors. And we use that experience to the benefit of our clients. If you're a qualified investor and want help building a tax-efficient investment strategy, go ahead and use the link below to connect with our team, and we'll get back to you. Thanks for watching today. I'm Brad Johnson with Evergreen Capital.